So, after a year of nonstop record highs, where it seemed like the party would never end, the market has suddenly and violently hit a wall. Something just feels wrong. And today, we're going to figure out exactly what is happening, why it's happening, and what it really means for anyone trying to make sense of all this chaos. Let's dive in. I mean, just think back to 2025. The feeling was pure euphoria, right? The S&P 500 was hitting new peaks almost daily, AI stocks were just on a tear, and the Magnificent Seven, well, they seemed absolutely unstoppable. And then, bam, 2026 kicks off. All of a sudden, the tech-heavy Nasdaq is down for the year, Nvidia takes a sharp nosedive even with good earnings, and literally hundreds of billions of dollars in market value have just, poof, vanished. The party is clearly over and panic is in the air. So the big question on everyone's mind is, what is actually going on here? Is this just a random market freakout, or is there something much deeper driving this sudden wave of fear? This isn't just a dip. It feels like a fundamental shift in how people are thinking, and we're going to break down the real reasons behind it. Okay, so our first major clue is something I like to call the Great Tech Hangover. You know how it works? After a massive, wild party in tech stocks, investors are now waking up with a headache and running for cover. They're stampeding into businesses they think are safe. And you can see this great divide right here on the screen. Money is just gushing out of the tech giants. We're talking Nvidia, Microsoft, Google, and it's flooding into these classic consumer staples like Coca-Cola and Procter & Gamble. I mean, these are the kinds of companies that are usually pretty boring. But right now, boring is exactly what scared investors crave. But is that actually the right move? We are definitely going to get to that. To really get to the bottom of this, we have to understand that this panic is not an accident. It's not random. It's the result of three huge, powerful forces, all hitting the market at the exact same time. And here are our culprits. First, stock market valuations were just stretched to their absolute limit. They were priced for perfection. Second, there are some very real and very dark clouds gathering on the economic horizon. And third, and this might be the most important one, investors are suddenly asking some really, really tough questions about the future of AI. So let's talk about those valuations. The key thing to get here is that the market was priced for absolute perfection. The S&P 500's price-to-earnings ratio shot up over 22, which is way, way above its long-term historical average of about 16. What that means is investors were paying a massive premium, basically betting that everything would go perfectly for years to come. And when you're priced for perfection, even good news can feel like a letdown. There's just no room for error. And on top of that, the whole economic picture is getting, well, pretty murky. Inflation is proving to be sticky, it's not going away easily. The Fed is getting nervous about cutting interest rates. We're starting to see cracks in consumer spending. And to top it all off, the threat of new tariffs could really squeeze company profits. So suddenly, that story of flawless growth the market was banking on, yeah, it's looking a lot less certain. All right, now for the main event, the AI panic. This is really the engine causing the most turmoil right now. And it's not just one thing. It's actually made up of three distinct fears that investors are grappling with. Let's break them down one by one. So, fear number one came out of nowhere. It was a shockwave called Deepseek. A Chinese AI lab basically announced they had built a world-class AI model that was just as powerful as the best stuff in America, but for a tiny fraction of the cost. This one announcement completely shattered a core belief holding up the market. The idea that you needed massive, incredibly expensive infrastructure to even compete in the AI race. And the market's reaction? It was absolutely historic. Nvidia lost roughly $600 billion in market value. That is the largest single-day loss for any company in U.S. history, and it was all driven by one single fear. The fear that Nvidia's total dominance in this space was maybe not so guaranteed after all. But here's where it gets interesting. There's this fascinating counterargument called Jevons paradox. The theory basically says that when a technology gets more efficient and cheaper, we don't use less of it. We actually end up using way more. Think about it. When electricity got cheaper, we didn't just turn our lights off more. No way. We invented a million new things to plug into the wall. The same could absolutely be true for AI. Cheaper models might just create an explosion in demand. Okay, fear number two is about the return on investment, or more specifically, the lack of one so far. I mean, just look at these numbers. They are staggering. Microsoft is spending $80 billion on AI infrastructure this year. Amazon, over $100 billion. These are just mind-boggling sums of money, and Wall Street is finally starting to ask the tough question, okay, when does this massive spending spree actually start paying off in real profits? And the third fear is maybe the scariest of all, obsolescence. There's a new story, a new narrative making the rounds on Wall Street, and it's that AI is going to make entire categories of super successful software companies like Adobe and Salesforce totally irrelevant. The market is essentially betting that their entire business models could just disappear within the next decade. I mean, that is a brutal, brutal verdict. So, with all this fear and panic swirling around, what are investors doing? They're doing what feels natural. They're running to what they think is safety. But as we're about to see, this is one of the oldest and most costly traps in the entire world of investing. And this slide shows that trap in action perfectly. The emotional investor feels really smart. They sell their tech stocks that are falling, and they buy these consumer staples that are rising. It feels disciplined. It feels safe. But the cold, hard financial reality is just devastating. They are selling low, and they are buying high. They are literally locking in their losses, all while thinking they're protecting themselves. And this right here is the absolute key takeaway. Chasing what feels safe by buying what has already gone up isn't a strategy. It's just an emotional reaction. It creates what the source material calls the illusion of safety, and it can absolutely destroy your long-term returns. So, if running for the hills is the wrong move, what's the right one? How does a disciplined, patient investor actually navigate this kind of turmoil? Well, let's get into the playbook. First things first, and this is so incredibly important, you have to remember that a falling stock price does not mean a failing business. Microsoft's Azure cloud business is still growing over 30% a year. Amazon's AWS is an absolute profit machine. And Google Search, it is still utterly dominant with 90% of the market. These are not broken businesses. Their stocks are down because expectations got way too high. And that leads us right to the playbook. And you know what? It's simple, but that doesn't mean it's easy. Step 1, do the work. That means you analyze the actual business, like Azure's real growth, not the scary red stock chart. Step 2, know what you own. This is about understanding the real, fundamental, long-term value of a company, completely separate from the market's day-to-day panic. And finally, step 3, have patience. That's the real superpower. It's the discipline to wait for a rational price before you make your move. And I want to leave you with this final thought. All the panic and uncertainty that we're seeing right now, it's not the enemy of a smart investor. In fact, it's the exact opposite. That uncertainty is the very thing that creates the huge gap between a great company's stock price and its true value. And it's inside that gap, for those who are willing to be patient and disciplined, where you'll find the absolute best opportunities.